Hello and welcome to Crossing the 49 at the Cross-Border Tax and Financial Planning Podcast. I'm your host, Phil Hogan from Beacon Hill Wealth Management, and today we're going to talk about 5 tax return mistakes I see on expat returns. Okay, so this will be a relatively short one. I know I've talked about this a lot, but these are always good reminders, and I see them all the time. So today we're going to talk about 5 errors or mistakes I see on expat tax returns. So these would be for tax returns for Americans living in Canada that file both Canadian and U.S. returns. And we're not going to talk about entry returns, those moving from the U.S. to Canada, because those tax filings can be quite complex, lots going on. But this is just for regular filing, somebody that's already been in Canada for some time. And they just have annual filings. These are in no particular order. Number 1 being incorrect use of Form 2555. So for those that are not aware, Form 2555, which is the foreign earned exclusion form, essentially excludes a certain amount of foreign earned income on the return. It's a relatively simple way to do the return. If you only have, let's say you work in Canada, you only have a T4. It's a pretty simple way to do the expat tax returns. I mean, I tend to prefer using foreign tax credits because you can accumulate foreign tax credits and use them in future years when you don't need them. But for simplicity, the 2555 is actually a really good way to prepare the tax return if you simply have wages. Now, the mistake I see people make is they will put other types of income on the 2555. So generally speaking, the only amount, and the exemption amount is just over, I think it's just over 100K now. Well, actually, I should check that. I'm not 100% sure, but around 100K. The exemption amount only applies to earned income. So it would be things like wages or business income. But we see all the time people including amounts on the 2555 to exclude them, the most common being pension income. And then sometimes we see investment income. So that's really important. Just when you're doing your 2555, really just earn income. You are not able to exclude any pension income for U.S. purposes, although foreign tax credits will eliminate most of the tax, if not all of it, all the time on Canadian pensions, but really just earned income. So no investment income and no pension income. So that's number 1, incorrect completion of the 2555. Number 2, I would say would probably be including only U.S. source income on the U.S. return and only including Canadian source income on the Canadian return. So we see this a lot, where you're reviewing a tax return, you see that they've included their IRA income on their U.S. return and their Social Security, and then on their Canadian return they have their CPP and their OAS, and they have their Canadian investment income and their Canadian pensions. For U.S. citizens living in Canada that are Canadian tax residents, you report your worldwide income in both countries. And I remember talking to a gentleman many years ago. He said, well, if I do that, I'm going to pay tax twice. And that's the reason why the treaty is in place. You report your worldwide income for both Canadian and U.S. tax purposes on the returns in each respective currency. But the treaty will take into account where that income should be taxed first and give you foreign tax credits or exemptions to eliminate double tax in most cases. So number 2, make sure you include your worldwide income on both returns. Okay, number 3 being incorrect reporting of Social Security income for U.S. purposes. So Americans living in Canada, as we know, or as we should know, you're only taxable on your Social Security income in the country of residence. Therefore, your country of residence now is Canada. You're only taxable on your Social Security in Canada. Now, you're not taxed on 100% of it. You get your 15% deduction, but it will only be taxed in Canada. You do, however, need to include disclosures in the return, in the U.S. return, to exclude the amounts of treaty disclosures. And in 8833, which is a treaty disclosure, but the form for this treaty disclosure. And the reason that's important is because if you tax the Social Security on your U.S. return and then tax on your Canadian return, and then try to get a foreign tax credit on your Canadian return, CRA would kick it out. So that's why it's important. I remember speaking to somebody a while back, and they was like, well, what's the difference whether I exclude it or whether I just tax it and then take a foreign tax credit? That's the difference. It won't seem like it'll make a big difference until CRA reviews the tax return, which they do. CRA reviews tax returns much more than the IRS reviews tax returns. And that's why it's important to exclude the amounts, because once CRA reviews the tax returns, then you will actually be in a position where you'll have to adjust the U.S. return. You'll have to adjust your Canadian return because you won't get a credit for taxes on U.S. Social Security in the U.S. Okay, so that was number 3. Number 4, we're going to talk about the incorrect completion of Form 1116, which is a foreign tax credit form. Now, that's a topic in itself. You could go on for hours about Form 1116, but just know we have, so the foreign tax credit form, and that form's in place so that, if you earn income from foreign sources, you can get credit for the taxes you paid to those foreign countries on that income. If not, you would pay double tax, and that's why treaties are in place, or that's one of the reasons why treaties are in place. For Form 1116, it's important to note, and people get this wrong all the time, which I understand. These things are complicated. It's why I think, it's the reason I don't try to work on my own car. It's why you probably shouldn't prepare your own tax returns. It can be very complex. The 1116 comes in different categories. So you might file a general 1116, which would include foreign wages, foreign pensions. Then you would have a passive 1116, which would include, things like capital gains and investment income, interest and dividends. And then you would have a resource 1116, which is a much more complex topic, but essentially use that form to resource amounts from the US to other countries because of the treaty. So yeah, number 4 would definitely be the incorrect completion of those 1116 forms, if not doing them at all. Okay, and 5, the final one, once again, these are in no particular order, would be, and this is not necessarily an error or mistake on the tax return. This is just how the tax returns are actually prepared. Now, we see this a lot, and I think the reason we see this is because there is quite a shortage of U.S. preparers in Canada. So if you don't know already, it's really tough to find a cross-border accountant in Canada currently, especially one with lots of experience and very competent that does U.S. tax returns or both Canadian and U.S. tax returns at the same time. So what often happens is a client, American living in Canada, will get a Canadian accountant to prepare their Canadian return. The return will get prepared, likely not filed, but sometimes filed. And then it will go to the U.S. tax CPA, which is often in a completely different firm, not associated necessarily with that firm, and they will do the U.S. return. So that U.S. firm can be in Canada, can be in the U.S. And the rule of thumb here is, in cases where all your income is Canadian source and you don't have any U.S. source income, that can likely work fine. And the reason for that is you're not going to have a foreign tax credit on the Canadian return for any U.S. source income. So I would say in cases where you only have Canadian source income, that would probably be a fine approach as long as you're happy with both the Canadian and U.S. accountant. Sometimes there's some efficiencies. Obviously, we're just doing everything in one firm in terms of cost, but that can definitely work. The times in which that becomes a real problem is when you have U.S. source income on your Canadian return. Because what will happen is, let's say the individual doing the Canadian return prepares the tax return, and let's pick an amount of it. So let's say the client has $10,000 in U.S. pension income. $10,000 in U.S. pension income. They prepare the tax return, and let's just assume that on the slip, so you get a slip for U.S. pension income, a 1099 slip in most cases, or 1042S, but a 1099 for $10,000 U.S., and it has 15% withholding. Now, remember, as an American living in Canada, American taxpayer, that 15% withholding is really just an installment tax. That's not your final tax because you're going to be filing an actual tax return. So the Canadian accountant completes that Canadian return, completes a foreign tax credit in that Canadian form for 15%, and then, let's say they file the return, which is very, very common. They file the return. Now, when the U.S. preparer gets along to doing the tax return, they'll report worldwide income on the return. And then when they go to tax the pension income, what happens if the pension income on the return is taxed at a marginal rate of 10%? Then you're in a position where the Canadian accountant just claimed 5% more tax than they should have on the foreign tax credit in Canada. And once again, this probably goes, gets swept under the rug if nobody looks at the return. But if CRA reviews the return, and of course CRA reviews tax return foreign tax credits all the time, they will look at it. They will ask for a copy of the U.S. tax return. They'll see that the tax paid on the U.S. pension was 10%, not 15%. They will kick out the additional 5%, and they'll send a bill to the taxpayer. On the surface, that doesn't seem like a huge deal, but they'll often either get the calculation wrong, you'll have to redo the tax return. But it's just such an unnecessary amount of effort and waste when you could have just done the tax return properly. So the lesson here is, when possible, get your tax return done, or get both your tax returns done in the same firm by the same individual that can file both the Canadian and U.S. tax return together, file them together. Now, once again, I know it's tough to find a good competent cross-border accountant, but when you do have that opportunity to get somebody in the same firm to do it, even if you're going to pay a little bit more, always worth it. I can't tell you the amount of returns that have been stuck in the system for such small ridiculous adjustments that could have just been done correctly initially. And remember, when you're talking to CRA, like these agents, I mean, they're likely overworked. There's not as many of them as there probably should be. They're not the ones making up these rules. So you want to be very patient when you're speaking to these individuals. They're not the ones designing these systems. So, I get this comment all the time about how, CRA is incompetent and this, and, I would make an argument maybe at the top level. I think, some of the systems are in place, do not need to be there, but the employees and the agents working there, they get lots of flack all day long. So whenever you're speaking to any of these individuals, try to be really patient and try to communicate. Even if you're frustrated, you're not frustrated with them, you're just frustrated with the system because they get a lot of negative energy, and I don't think that's necessarily fair. So anyway, so there you go. That's 5 mistakes or errors I see on expat tax returns. There's many more, but those are kind of the top 5. So I hope that's been helpful. Hopefully that helps with your preparation, with your communication with your CPA. If you need help with any cross-border tax or investment issues, feel free to reach out. We have a complimentary consultation link below. My email address is below, so feel free to reach out. Big thanks to everybody that's subscribed to the channel. If you haven't already done so, make sure to join the Facebook community, our Expat Americans Living in Canada Facebook community, and we'll see you on the next one.